Inflation is not a modern phenomenon, but one deeply rooted in historical monetary policies. The story of contemporary inflation began in 1933 with a pivotal monetary adjustment in the United States, under the administration of Franklin D. Roosevelt. The dollar-gold exchange rate shifted from $21 to $35 per ounce of gold. This change aimed to stabilize the U.S. economy during the Great Depression, but had far-reaching consequences. By artificially inflating the dollar's value in gold terms, Roosevelt's decision introduced a controlled deflation that temporarily revived the price system. However, it also set the stage for continuous money printing, which has fueled inflation for nearly a century. The 1933 adjustment was not just a solution to a crisis, but the beginning of a global economic structure based on perpetual monetary expansion. For decades after 1933, the U.S. maintained the dollar's link to gold at $35 per ounce. This peg allowed some stability, but it was increasingly based on a myth. By the 1960s, the dollar's actual purchasing power had diverged from its gold backing. Foreign nations began questioning the U.S.'s ability to honor its gold obligations. In 1971, the illusion ended when President Richard Nixon formally abandoned the gold standard. This pivotal decision, known as the Nixon Shock, untethered the dollar from gold, allowing it to float freely in global markets. The immediate consequence was an acceleration of inflation. Without gold as an anchor, the dollar became entirely fiat, its value derived solely from trust and government decree. This shift marked the dawn of unrestrained money creation, with profound implications for global economies. The abandonment of the gold standard unleashed a monetary system reliant on debt. Over the decades, debt levels across governments, corporations, and households grew unchecked. This trend became particularly pronounced in the 2000s. For example, the U.S. housing boom of the early 2000s saw individuals and institutions taking on massive debt loads to finance property purchases. When the bubble burst in 2008, the resulting financial crisis revealed the fragility of the debt-dependent system. Today, debt permeates all levels of society. Few individuals or entities are free from its grasp. The global monetary system, designed to accumulate debt continuously, contradicts nature's principle of balance. In nature, excess is eventually corrected. In the financial world, however, debt has only grown, creating instability and threatening to collapse the very foundations of the system. The dollar's purchasing power has already been on a steady decline for decades, but the pace is expected to accelerate. In an inflationary cycle, goods and services become increasingly expensive, eroding the value of currency. This gradual devaluation often masks the underlying fragility until a tipping point is reached. Historical examples of hyperinflation provide valuable insights. In Germany in 1923, the Weimar Republic experienced hyperinflation due to excessive money printing. Prices rose so rapidly that wages had to be paid daily to keep up with living costs. Similarly, in Israel in 1984, inflation spiraled out of control, requiring significant monetary reforms. The risk today is that the dollar, the world's reserve currency, may face a similar fate. Unlike previous instances of hyperinflation limited to smaller economies, a dollar collapse would have global ramifications. As the dollar's purchasing power declines, the world could witness unprecedented inflationary pressures. Amid the instability of fiat currencies, gold has historically remained a constant. For centuries, gold served as money because of its intrinsic qualities: scarcity, divisibility, and durability. Even today, despite the dominance of fiat currencies, gold retains its status as the ultimate measure of value. If the dollar collapses, gold's monetary value could skyrocket. Some estimates suggest it could exceed $30,000 per ounce, reflecting the true scale of monetary inflation since 1933. This figure is not merely speculative, it is derived from dividing the Federal Reserve's balance sheet by the amount of gold in its reserves. Such a recalibration would reveal the dollar's actual worth relative to gold and highlight the unsustainable nature of fiat systems. In previous eras, monetary collapses unfolded over months or years due to the logistical limitations of physical currency. For example, during Germany's Weimar hyperinflation, the distribution of physical paper money slowed the process. Today, however, financial technology enables instantaneous transactions. Payments occur in seconds, whether via Bitcoin, Apple Pay, or traditional digital transfers. This technological advancement could amplify the speed of a collapse. Imagine a scenario where trust in the dollar erodes rapidly within days or even hours. The value of the dollar could plummet. Prices for essentials like food and energy could double overnight, triggering widespread panic. Unlike historical collapses, where alternative currency served as a fallback, a collapse of the dollar as the global reserve currency would leave no clear alternative. Gold, once again, may emerge as the only viable anchor for a new monetary system. One of the key weaknesses of fiat systems is their reliance on centralized control. Governments and central banks dictate monetary policies, often ignoring the realities of supply and demand. In contrast, effective monetary systems are shaped by market forces. Historically, money emerged organically. Early societies traded goods directly, but this system was inefficient. Over time, gold and silver became the preferred mediums of exchange due to their universal acceptability and intrinsic value. Paper currencies initially derived their value from being redeemable for gold or silver. However, when fiat currencies severed their ties to precious metals, they became vulnerable to manipulation. Market forces are essential for determining the true value of goods and services. A fiat system, disconnected from reality, distorts resource allocation. Only a return to a market-driven approach, possibly anchored by commodities like gold, can restore balance. Given the unsustainable nature of current monetary policies, a transition away from fiat currencies like the dollar seems inevitable. The question is not if, but when and how the transition will occur. Historically, monetary resets have been disorderly. The collapse of one system often leads to chaos before a new equilibrium is found. For example, following the collapse of the Weimar Republic's currency, Germany adopted the Rentenmark, a currency partially backed by land, to stabilize its economy. Similarly, the post-World War II Bretton Woods system established the dollar's dominance but was itself a response to earlier monetary failures. Today, the transition may involve a return to commodity-based systems, decentralized currencies, or a combination of both. While such a shift could bring long-term benefits, the short-term disruptions are likely to be significant. The end of fiat currencies could usher in a period of uncertainty, with gold playing a central role in rebuilding trust in money. The journey of inflation from 1933 to today tells a story of systemic imbalances and unsustainable practices. From the dollar gold peg to the abandonment of the gold standard, from unchecked debt growth to declining purchasing power, the trajectory has been clear. Historical lessons from hyperinflation and gold's enduring role as money provide a roadmap for what lies ahead. As the dollar faces mounting pressures, its eventual decline appears inevitable. Whether through a gradual erosion of value or a sudden collapse, the world is poised for a monetary reset. In this uncertain future, gold may once again emerge as the foundation of a stable economic system. The transition will not be easy, but it aligns with the natural rhythms of markets and history. Preparing now by understanding these dynamics is the key to navigating the challenges to come.